Welcome to The Explainer. Today, we're taking a seriously mind-bending journey from the absolute macro to the very micro, looking at the rapidly shifting landscape of global finance. We're going to zoom way out to look at the massive tectonic plates of international money, and then we'll zoom right back in to see exactly how those massive shifts actually trickle down to the financial traps waiting right on your smartphone.
Here's our roadmap for today. 1. Global money and markets. 2. The AI IPO frenzy. 3. Navigating new tax rules. 4. Real estate and tariffs. And 5. Beware of Finfluencer scams. Let's dive in.
Section 1. Global money and markets, the shifting foundations.
$40 trillion. Take a second and just let that number sink in. That is the current U.S. national debt. Now, you might be wondering, why does this matter to you? Well, because with inflation roaring back and proving to be pretty sticky, the bond markets are actively pushing interest rates higher all on their own, without the Federal Reserve even having to lift a finger. The bond market is literally repricing the entire financial system. And this higher cost of borrowing? It's squeezing the global economy tight, making debt vastly more expensive for absolutely everyone, from sovereign governments right down to everyday consumers buying groceries.
And that massive, towering debt burden leads us to a pretty pivotal question. Will the US dollar actually survive as the world's reserve currency? Look, when you combine rising debt with the aggressive use of economic sanctions by the US, other nations are definitely starting to rethink their reliance on the American financial system. They're actively hunting for ways to bypass the dollar so their international trade can't just be turned off overnight.
And we're seeing nations respond in some genuinely fascinating ways. If you contrast the traditional, US-influenced SWIFT banking system with Russia's brand new cryptocurrency law, you see exactly what I mean. See, this isn't about regular Russian citizens buying a little Bitcoin on the weekend. It is a highly strategic tool for international trade. It allows Russian companies to settle import and export contracts directly using crypto, completely bypassing the US dollar. But here's the catch. To prevent a massive capital flight, everyday Russian citizens are legally capped at buying just $3,700 worth of crypto a year, and they can't even spend it domestically. It's a purely macroeconomic defense mechanism.
Okay, moving to Section 2, the AI IPO frenzy, the liquidity magnet.
We are witnessing a wild, almost unprecedented discrepancy right now. Tech mega IPOs are gearing up to enter public markets with anticipated valuations nearing $1 trillion, yet they completely lack traditional profitability. Take OpenAI, for example. They're projecting a mind-bending $600 billion in computing spend by the year 2030, but that's offset against only $25 billion in annualized revenue today. I mean, they are burning through cash at a staggering rate, which is exactly why they so desperately need to tap into public market liquidity just to keep the lights on.
And the concentration of this capital frenzy is honestly staggering. Between SpaceX, OpenAI, and Anthropic, they are set to raise more money going public than all other US IPOs combined since 2022. They are an absolute vacuum for capital. But this raises a massive question for regular retail investors. Are you actually buying into the future of technology, or are you just funding an unsustainable cash furnace?
Section 3. Navigating new tax rules, protecting your gains.
In the US, there's a super interesting political debate unfolding right now around capital gains. Think about this. The primary home capital gains exemption hasn't been updated since 1997, and the net investment tax threshold has been totally frozen since 2013. Now we're seeing proposals floating around to index capital gains taxes to inflation. The logic here makes sense to a lot of people. Investors shouldn't be paying taxes on phantom gains where an asset's value only went up on paper just to match the rate of inflation. If this passes, it could significantly alter the housing and stock markets by freeing up a ton of frozen assets.
Speaking of taxes, let's look up north to Canada and define a term that has caused some serious viral outrage online lately: deemed disposition. There's been this incredibly politically charged debate about Canada suddenly having a 55% exit tax for citizens trying to leave the country. But let's clarify what deemed disposition actually means. It simply means that when you sever residential ties with Canada, the government treats your assets as if you sold them the day before you left, taxing the unrealized capital gains. When you strip away all the online sensationalism, the actual mechanics are a lot less scary. First off, the maximum capital gains rate is 26.65%, which is nowhere near that 55% number being thrown around on social media.
Plus, there are massive exemptions in place for retirement accounts, tax-free savings accounts, and Canadian real estate. Where this tax actually hits hard is on individuals who hold highly appreciated, unrealized gains in private corporations. Ultimately, it's a mechanism designed to prevent tax evasion right before leaving, not a flat, confiscatory wealth tax on every single thing you own.
Section 4. Real estate and tariffs. The micro impact.
The Canadian condo market is currently experiencing a staggering crash. Toronto sales have plummeted 90% from their peak, and Vancouver is down 66%. Why? Well, it goes right back to those high interest rates we talked about earlier. Developers spent years building these tiny, unlivable glass boxes entirely for investors who just wanted to flip them. But with borrowing costs through the roof and investor demand totally evaporating, you've got massive unsold inventories just sitting there vacant, actually forcing the government to step in and try to buy up units to prevent these developers from going totally bankrupt.
And layering onto all that economic friction, we are seeing unprecedented trade wars hitting domestic economies right now. The U.S. recently announced a massive 50% Section 338 tariff targeting $20 billion in Canadian exports, hitting autos, alcohol, and yes, even cheese. This is being stated as a reciprocal response to alleged Canadian trade barriers like certain provinces blocking U.S. alcohol sales. It's a perfect, textbook example of how high-level global political posturing results in immediate, real-world price increases for everyday consumers like you and me.
Which brings us to Section 5. Beware of Finfluencer scams, defending your portfolio.
A recent study called Pay to Pump revealed a genuinely terrifying trend online. Zero-revenue mining and tech companies are literally pouring cash into social media personalities. They're even generating fake AI avatars of politicians, all to manipulate their stock prices. They use manufactured hype to pump a stock up by nearly 8% on the exact day a video drops, which allows insiders to cash out and sell. Then, predictably, the stock plummets right back down within 30 days, leaving the retail investor completely holding the bag. We're even seeing prediction markets paying creators to place fake bets on dummy websites just to lure viewers in. It is wild out there.
So how do you actually protect yourself from all this noise? Well, here is a quick 3-step playbook. First, always verify regulatory disclosures. Do not just trust a quick, blurry tag in the corner of a video. Second, actually look up the company's revenue. If they've been around for a decade and haven't made a single actual dollar, run. And third, you have to separate the macro trend from the micro reality. Look, just because AI or copper is booming on a global scale, it absolutely does not mean that some random penny stock actually has the proprietary tech or the viable ore to capitalize on it.
Which leaves us with this final, vital question. The tectonic plates of global finance are shifting right under our feet, fundamentally rewriting the rules of money from the highest international banking systems all the way down to the targeted ads on your social media feed. With all this turbulence going on, what active steps will you take today to protect your portfolio and safeguard what you've built? Stay focused, stay curious, and always, always verify the data. Thanks for joining this explainer. We'll see you next time.